Hi there, and welcome to Talk ETFs, ETF.com's weekly video series. My name is Sumit Roy, and I'm Senior Analyst here at ETF.com. This week, I'm speaking with Brian Jacobsen, who's the Chief Economist at Annex Wealth Management. Brian, great to have you on the show.
Oh, good to be here. Thanks.
Absolutely. So, Brian, this week has been extremely eventful, so there's a lot to talk about. We're recording this on August 1st, so a day after the Fed meeting and a day before the jobs report for the month of July. I want to ask you first about the Fed meeting. Powell seemed to open the door to a rate cut in September, which the market initially liked, but the next day, which is today, the day we're recording, the market started to reconsider that view. And we saw the stock market sell off pretty significantly, 1.5%, a little more than that, because some people are concerned that the Fed might be behind the curve and that, it should have already cut interest rates. What's your take? Do you think the Fed is behind the curve?
I don't think they are, but I understand why people might believe that they are. The ISM manufacturing number that we got this morning was really bad. It really indicated that the manufacturing sector isn't just really going through some troubled times as far as just contraction. It's almost beginning to crack. When we saw the production numbers, they were at levels that we saw back in 2019 when there was a growing divide between service sector activity and manufacturing activity, and that was a prelude to a Fed rate cut. Now, we all know that after the Fed started cutting rates, it actually, we had COVID, and I don't blame the Fed for COVID, of course, but I think that I actually take a little bit of comfort in knowing that if the Fed does cut in September, that should be in just enough time to maybe relieve some of the pressure on manufacturing firms. But the jury is still out. And I think that really some people are thinking that the Fed has held rates too long for too high. If you consider that we just celebrated the 1-year anniversary of the Powell pause. The other long period of time in which we did have a pause was back in 2004 to 6, where there was a 15-month pause, and that preceded the global financial crisis. So I think people are kind of looking at the numbers and just saying, this is a lot like 2019, maybe a lot like pre-financial crisis, and let's take some chips off of the table right now.
And Brian, another area of concern that investors have had is the jobs market. We're going to get the latest jobs figures on Friday. And, in previous months, the last few months, we have seen some cooling in the labor market. But overall, it still remains pretty solid. And that's how Powell characterized it as well. Do you expect the labor market to remain solid, or do you think there's a chance that it could significantly weaken?
I do think that there is a chance that we could see a significant weakening, but I don't think it's going to snowball into some sort of recessionary scenario. We did see the initial unemployment claims number kind of spike higher from the previous week. And so that's a little concerning. It's the highest it's been in over a year. Now, a lot of that was driven by Michigan and Missouri, possibly due to some, seasonal variations. Summer times are very difficult when it comes to initial unemployment claims because you have seasonal workers. You also have automobile manufacturers retooling. So maybe it's just some weird seasonal adjustment, but I did take notice that that number did jump higher than I wanted to see. I do want to see it move slightly higher, but not by as much. So there is a risk that we are seeing some more weakness. If you consider where has the strength been, it's been in the non-cyclical areas, mostly like healthcare and government employment. So that's not exactly a real solid foundation for the labor market. Maybe the labor market isn't quite as solid as what Powell is letting on.
Let's talk a little bit about the market movements now, Brian. On Thursday, the 10-year Treasury yield fell below 4% for the first time since January. Is the bond market starting to price in, a slowdown in the economy or even a recession?
I think it is. Some people were talking about how maybe this is an unwinding of the Trump trade because all of a sudden you see, candidate Harris or presumptive candidate Harris rising in the polls. And so maybe that means that we aren't going to see higher yields and we're not going to see a stronger dollar. And so we see a little bit of a reversal of that. I think most of it is really driven by the economics here. Just we had some pretty bad growth data. And if you consider that if the Fed is starting to cut, the Bank of England has already cut. We know that the ECB has already cut. So globally, you are seeing this cutting cycle beginning that should help keep those longer term rates from rising too much more. And in fact, they could possibly pull them lower. So I think that it's really the central banks beginning to cut rates combined with the somewhat weaker data that we're seeing that's bringing those yields down. I think that here at Annex with our investment committee, we think 4 to maybe 4.25% is pretty fair value on the 10-year treasury. So we're a little bit below that, but it's not anything that we are really all that worried about. I actually do kind of like the fact that when the equity market sells off, you're seeing bonds rally. That's a pleasant change of pace. If you kind of consider a balanced portfolio over the last couple of years has been really challenged because when stocks sold off, bonds sold off too. This is maybe a kind of a going back towards the period of time in which bonds can finally diversify stocks again.
Great point. And as you mentioned, Brian, the stock market has been pulling back. It seems like this is the second sort of mini correction we've seen so far this year, a pullback of around 4 or 5% in the S&P 500. Do you think this could turn into something bigger, a 10% correction, or maybe even more?
When I look at some of the indicators about what could trigger that type of correction, let's say a 10% move, and then let's say a bear market is a 20% move, oftentimes the corrections are triggered by a rising fear of a recession, fear of inflation coming back, or fear of some geopolitical issue. Well, if you kind of think about what we have now, fear of recession coming back with those manufacturing numbers, increase in initial unemployment claims. Inflation doesn't seem to be as much of a worry, but we have plenty of those geopolitical fears as well, especially between Israel and Iran. So I think there is a possibility that it does become a 10% correction. Would it become an actual bear market? That would require, I think, those fears to become reality. And that's where the labor market strength is really going to be a pivotal thing to really be watching. If we see wage growth continuing, if maybe we see a little bit of spreading of the job gains, so it's not just concentrated in these non-cyclical areas, I think investors could breathe that sigh of relief. But we are really in for some challenging times here.
Finally, Brian, before I let you go, I want to ask you about this whole rotation within the stock market that we saw, over the past few weeks. We saw small caps significantly outperform large caps, and in particular, mega cap stocks. That seems to be kind of reversing today with the recession fears. Do you think, the rotation can last, or does it kind of depend on what happens with the economy?
Yeah, that's one of the challenges with these rotations. They actually oftentimes are more like roller coasters than rotations, where you do have them really advancing and then declining, the outperformance, underperformance. I kind of look back at, like, let's say the 94 to 95 period when the Fed was beginning to cut rates. That's when they navigated that soft landing. If you kind of look at value versus growth, for instance, there were like a couple of weeks at a time in which value would charge ahead and then growth would, and they would alternate. And then you look at large versus small. Very similar story. So it wasn't as though it was just like this really massive rotation that stuck. It was more of a rotation that was like that roller coaster that took you back the other way. That's probably where we're in now until we get a little bit more clarity on the economic picture. I've been looking at the data on the small cap premium and the value premium, and it's really that when you get a cyclical upswing. So I think really to get that rotation to small cap and value to stick, we would really need to see the economic numbers start to improve. Right now, we're going through more of that deterioration phase instead. So I'm expecting more of a roller coaster than a rotation.
Fantastic. Well, a ton of great information, Brian. It's been a pleasure having you on the show. Thanks so much for your time.
Oh, my pleasure. Thank you.